Hello there, welcome to this final module of entire financial modeling of a startup series. This is part 2 of module number 5, that is cash flow statement. In this video, we are going to model out entire cash flow statement for the next 3 years using our case study. After this entire series, you will have a project ready with you which you can showcase in your resume and present it alongside during your interviews. We are going to model this cash flow entirely on Excel using step-by-step approach. You also start building alongside the video so that whatever you learn you apply it practically. You can download template from link in the description below. So hello everyone, my name is Karan Damania. I am an ex-investment banker turned founder, and through Encoding Careers we help you build successful career in finance. So let's get onto the screen and work on building our model. Okay, so here we are on the template of cash flow statement where now we will be calculating cash flow for the next 3 years. In the previous video, we calculated the cash flow for the current year where we understood how much cash does Sandy have in his bank account based on these three elements of cash flow, that is CFO, CFI and CFF. Now in this video, we are going to understand how will it be calculated when we are projecting for the next 3 years based on the assumptions that we have taken. Initially, we will plug in from the P&L and balance sheet what are the elements that we need to take into the cash flow statement. We did that in previous video as well, so that we have a check that we have plugged in all the amounts in proper manner. So let us start with P&L. As we have the entire P&L statement ready with us, we will now see what are the elements that we need to take in the cash flow statement. So we know that we don't take any of the above elements up to EBITDA because that is all being expensed out and the revenue is recognized. The main elements start after EBITDA, where we have depreciation which goes into the CFO and is subtracted from CFI. Next we have interest expense, which is once again added in CFO and subtracted from CFF. So that is it. And finally we have net profit after tax, which we are going to take to CFO. Perfect. So from P&L we have all the elements ready with us. Next we will move on to balance sheet. Because the revenue and OPEX sheet are only supplementing ones, we don't take any element from that into the cash flow statement. Starting in balance sheet, we have the first element, which is non-current assets. These are the investment that we are making into the business, which represent the investment amount. This will be cash flow from investing. Next we have cash and bank, which is calculated from the cash flow statement, so we are going to calculate it. Next is receivable from client, this is CFO. Inventory is also CFO. We have long term bank loan, which is a CFF, where we are raising funds from bank and it is a financing activity. Next we have current liabilities, which is once again CFO, as the only element in our current liability is the payable, which we saw in the balance sheet module when we created it. So that will be CFO for us. Next we have the total liabilities, which is already calculated using about to, which we have already placed. In the equity we have share capital, which we are going to take it CFF, and the final amount of retained earnings we have already taken profit and loss, so we are not going to use retained earning into cash flow, or else it will be a double entry. So that way we have marked all the elements which we are going to plug into the cash flow statement. Currently we can see that there is a check balance we have, and in the current year we have it as 0. The check balance is the difference between the liabilities and the asset. So we can see that the total assets are at 468 and we have 2595 as our total liabilities. So there is a difference of 21,27,000, which if we get through our cash flow statement, the balance sheet will tally. We will start with cash flow from operation. The first element that we have is net profit after tax. So we are going to plug this from P&L. We have 4,887 for year 1. We will calculate the entire year 1 of projected cash flow statement. So first we will plug in data for entire year 1. We will add back our depreciation amount from P&L, which is 64,500. This is given a negative sign, so we will add a negative sign once again and this becomes positive for us. Then we add back interest, which is 15,000. Once again we give a negative sign to this. Then we have increase in receivable, increase in payable and increase in inventory. So here we have to take care now. In the previous part when we calculated cash flow for year 1, we only had amounts for that particular year and all the amounts were taken as it is. But now we have a previous year with us, so we need to take into consideration the changes in it. So to calculate increase in an asset, we give a negative sign. We look at the current year, which is year 1, and then we add previous year receivable. So that way we have increase in receivable as 20,562. Previously it was 20,000 and this year it is 40,562, which is an increase of 20,562. Similarly, we will do it for payables. Now for payables, we don't have to give it a negative sign, because in payables, if a liability is increasing, that is cash inflow for us. So here we will directly take liability as it is, which is 27,000, and then we subtract both of this amount, that is 15,000 and 5,000, which gives us 7,715, which is increase in payable. That is, our payables have increased from previous year. Previous year we were at 20,000, and this year we are at 27,715, which is a cash inflow for the business. Finally, we will calculate the inventory amount, which will be increased for the current year. So we will give it a negative sign, as increase in inventory will mean cash outflow for the business. So in the balance sheet, we will take inventory amount, and then we will add the previous year, which was 10,000. So that way we have negative 14,944 as our inventory for the current year. Now we need to sum this entire cash flow from operation and see what is the balance that we have. So this will be sum and total of this three. We have 56,597 as our cash flow from operation. We can see that the profits that business generated was 4,887, but the business generated cash of 56,597. This is because of depreciation which we are charging, as we have now assets in the business. This is due to increase in receivable, right? This is due to increase in inventory, that the cash is different from the profit account. Similarly, we will now come to cash flow from investing and plug in the numbers. So for cash flow from investing, we are going to plug this from the fixed asset schedule that we have created. In year 1, we are adding 2,25,000 worth of kitchen setup. We are going to add this. This is a cash outflow, so it will stay as negative, right? So we will give a negative sign, and we are also adding furniture to the business, where we are once again going to give it negative sign, and the amount for this is 1,20,000. So total cash flow we have spent into investing of assets will be sum of these two, and it is negative 3,45,000. Okay, so that way we have completed CFO and CFI. Next, we are left with the final element, which is cash flow from financing. So when we look at the balance sheet, we have two elements for CFF, that is the long term loan account and the share capital, which we will plug into our cash flow statement. For the loan amount, we are going to use our borrowing schedule, but we will start with share capital, which we can easily take from the balance sheet. The first amount is share capital, where we have now raised 20 lakhs in funding. So that entire equity amount is going to come into the bank account. We will add 20 lakhs to the cash flow statement. To calculate that amount, we have to add net amount that is added through share capital in current year, which we can do it as subtraction of current year, which is 20 lakh 50,000, minus the 50,000 which was raised in the previous year. Here this means that we have total equity of 20 lakh 50,000 with us, but out of that 50,000 was raised in the previous year, so we cannot add it as cash for current year. We have to subtract it. That way we get 20 lakh as our cash balance from equity share capital. Let's go to borrowing schedule and see how we can add that amount. In the previous year, we added 1 lakh worth of borrowings to the business. Now in the year 1, we are adding 1 more lakh to the business, but this time it is based on reducing balance. That is, we are paying EMIs to the bank, and every year there is a deduction of principal from the entire loan amount. So in the previous year, when we added a loan amount to the cash flow statement, we only had interest portion deducted from the loan amount, that is 1 lakh minus the 15,000 amount of interest, which gave us net cash flow of 85,000 from the loan amount. But this year we are paying the previous year's interest, that is 15,000. We are paying 28,000 as the current year principal amount, and 13,000 as the interest on the 1 lakh loan that we have taken for current year. So we have to subtract all these three from the current borrowing. The loan taken will be 1 lakh rupees that we understood in the year 1. So we can plug this directly. To understand the loan repayment, which is the principal and interest portion, when you took a loan of 1 lakh rupees, you got the entire amount into your bank account. But through the entire year of 12 months, you paid interest plus principal portion back to the bank as your EMI. So that way your amount that you have taken is already getting reduced. That way you have to reduce the entire principal and interest from your cash flow as well. That for that we will sum the entire payment for interest and principal from here, which is the total of these three, and give it a negative sign as we have paid it back. So we have 56,597 as the entire amount of principal and interest. To calculate the net cash flow, we will sum this entire amount, which is 21 lakh and the principal interest. We have 20 lakh 43,403 as our net cash flow from financing. To calculate the closing cash balance, which we can take to the balance sheet, we have to calculate the net cash flow and the opening cash balance. So we have two elements pending with us. The net change in cash is equal to cash flow from operation, cash flow from investing, and cash flow from financing. So we will sum these three elements up, which is CFO plus CFI plus CFA, which gives us 17 lakh 55,000. And we have opening balance of cash with us, which is the previous year's closing balance. So that way we will directly plug it from previous balance, which is 3,59,600. Now to calculate a closing balance, this is sum of the two, which is net change in cash plus the opening balance, which will be reflected in the balance sheet as our closing bank balance. So this is equals to sum of these two. So 21 lakh 14,600. Now let's take these to balance sheet. So when we plug in, so we need to plug in this from cash flow statement. Now we have 21 lakh 14,600 as our cash balance for year one. When we see our check, we are having a reference error of 13,092, which we need to solve for. Because of this, the balance sheet is not tallying. We can see that the asset is less than the liabilities. For this, we need to have a reference check to the entire cash flow statement. We can see that the interest element that we took is same as the previous year, and when we check in the formula bar, we took PNL C16, which is the interest for previous year, that is 15,000. We need to make this interest for current year, so we will change this error and plug in the interest for current year. So we have to change the negative sign, and that way we have CFO now changed to 69,689, and we have our closing cash at 21 lakh 27,692. Going back to the balance sheet, we can see that there is no reference check. That is, the check is zero now, and our balance sheet is tallied for the year one. Now the task that you guys have is to calculate year two and year three cash flow statement and tally up your balance sheet. You can download the template of this cash flow statement from the link in description and start working on your own model. Alright, so that was it for the entire financial modeling of a startup series. Hope through this series you got to learn how a financial model is built from scratch using a step-by-step approach. Do let us know in the comments what next skill set are you learning, and we will try to create a detailed series on that. So that is it for this video. See you in the next one. Until then, this is Karan Damania taking your leave.